Today on InvestTalk, we talked about what to do after paying off your mortgage, answered questions on CCL, holding gold physically or in ETFs, and ticker LEG, then ended the day talking about why gold has had a historic run.
This is InvestTalk, independent thinking, shared success.
My main focus point today concerns this question. What happens when you pay off your mortgage? Paying off your mortgage is a significant milestone, offering financial freedom and emotional satisfaction. However, it comes with responsibilities and considerations that you really shouldn't overlook. So today, let's break down what happens after that final mortgage payment and how to manage the new landscape of home ownership. When you pay off your mortgage, your lender will send you several different critical documents, including a canceled promissory note, confirming that your loan obligation is fulfilled. Aside from that, you also receive a deed of reconveyance, showing that the lender no longer holds any legal claim on your property. So keep an eye out for any remaining escrow funds because those should be refunded within 20 days of closing the account. Now, paying off your mortgage doesn't mean you're free from any ongoing expenses related to your home. In fact, you'll now be responsible for paying property taxes and homeowners insurance directly, which your lender likely managed through escrow. Be sure to notify your insurance company to remove your lender from your policy, ensuring that any future claims are reimbursed to you and not to the bank. Another key step is to update your financial plan. Paying off your mortgage might slightly lower your credit score since it reduces the mix of debts on your credit report, so it's important to stay proactive, reviewing your credit report regularly and notifying credit card companies of the change, because this could open opportunities to increase your credit limits. But there's something else you need to consider. Now that you're saving on mortgage payments, what should you do with all that cash? It was a great time to focus on other financial priorities. Maybe you need to pay down your high interest debt. Maybe you want to bolster your retirement savings. Maybe you want to save more for your kid to go to college. Or maybe you just need to increase your emergency fund. All of these are important goals that you should use that newfound mortgage payment savings towards. It's also the question of whether prepaying a mortgage makes financial sense. This is something that we get a lot. Some people don't like having debt, but sometimes it makes more financial sense to carry that debt. If your mortgage carries a low interest rate, below 5%, below 4%, maybe you're one of those people that has the lucky 3% mortgages, well, it might not be the smartest financial move to accelerate payments. Why? Opportunity cost. If the market is on average returning above what the interest on your mortgage is, well, that's the opportunity cost of paying off that debt early. Maybe you should focus on higher return investments, maximizing your 401k or IRA contributions, or paying down that debt like credit cards. If you still decide to pay off your mortgage faster, you can either make extra principal payments or refinance into a shorter loan term. The bottom line, paying off your mortgage is a huge achievement, but it's just the beginning of a new financial chapter. So by staying organized and reallocating your savings wisely, you can ensure that this milestone supports your long-term financial health and helps you achieve your financial goals.
We appreciate you watching. Don't forget to like this video and subscribe to our channel for more content.
Let's shift gears and talk about the market today. U.S. stocks finished lower, though ended off of their worst levels. The S&P was down for the third straight session for the first time since early September. The Dow down 96 basis points, S&P down 92, NASDAQ down 1.6, and the Russell 2000 down 79 basis points. Big tech was broadly lower, as you can guess by looking at the NASDAQ. Other underperformers included semis, retail apparel, autos, beverages, trucking. Relative outperformers included utilities, telecom, paper packaging, and hospitals. Dollar index was up 30 basis points, with yen weakness really being the big story on the FX front. Gold finished down 1.1% after a 6-day run further into record territory. Crude oil ended down 1.4% after the past 2 days of pretty solid gains. Overall, the market continued to back off of Friday's S&P record close, which capped off its 6th straight week of gains. Bond volatility today with MOVE Index, the highest since last December, certainly something of note. Mixed earning takeaways as well were some of the primary focus of the market. And existing home sales for September posted surprise decline, coming in below expectations at the slowest pace in 14 years. Fed's latest beige book also sees economic activity as little changed since September, with more optimism about the longer-term outlook despite near-term uncertainty. No policy comments from anyone from the Fed today. Outside the US, Bank Canada cut its benchmark rate by 50 basis points, but that was to be expected. In terms of the economic calendar, a little bit busier tomorrow with initial claims, PMIs, and new home sales. And Friday brings durable good orders and the final University of Michigan consumer sentiment, as well as inflation expectations for the month of October.
Hi, I was calling about Iron Mountain. I'm up about 100% on it. I wanted to know if I should sell it, keep it, or just buy more. Thank you for your help.
Iron Mountain, other than being an excellently named stock, is a real estate investment trust that primarily focuses in data centers. And so with the rise of AI, of spending associated with data centers, understandably, this REIT has done particularly well, up 112% over the past 52 weeks, up 79% year to date. And a lot of that is because revenue growth really exploded coming out of the pandemic. You went from about 4.4 billion in revenue to projected to be 6.1 billion this year. Their margins look pretty solid. Their operating margin looks good. That key thing right there, funds from operation per share, that's what we look at with REITs, has also grown from $3 to about $4.49 per share from 2021 until now. Their balance sheet, it looks fine. Remember, REITs primarily operate on debt financing. They have about $15.6 billion in debt on a $36 billion market cap REIT. They pay a solid dividend, 2.3% is where it is right now. Now, historically, it's been from 5 to 8%, anywhere from 5 to 8%. And that's with dividends per share growing from about $2.37 projected to be $2.69 this year. They have issued some shares, but not a crazy amount of shares. So what does that mean when the dividend yield goes down substantially? They haven't issued a lot of shares. The dividend hasn't really changed much. Well, that tells you that the price has run up a lot, and that is exactly what we see. And so with this company, I think the reason why, even though it's had a big run up, even though it's in a good space, I think now's the time to trim. Look at this price relative to its funds from operation, 25.5. A lot of times you look at price to earnings. Well, as I mentioned, we care about FFO for REITs. So price to FFO, 25.5 times. That is the upper end of that range. This thing looks incredibly overvalued to me. And so I would take some of those gains. I would certainly at the least trim. I would not buy more, but I think now is the time to take profit. Thanks for the call. Looks like we have a live call. Love live calls from Dan from Walnut Creek. This question about NAC. Do you own it? Or are you looking to buy it?
Hi there, Luke. Thanks for taking my call. Yeah, I own it, and I was wondering what to do with it. I had spoke to Justin a couple of weeks ago, and he had explained that the reason it had increased in previous months is because people were pricing in the future Fed rate decreases, and then why it hasn't. I thought it might continue to go up in price after the increases were implemented or decreases were implemented, but he was saying, no, those were already priced in. So a follow-up on that, I was up about 25%, and now I'm up only about 11%. It has like a 7.5% dividend, but also has a 4% expense ratio. And I'm not too sure it's looking that the Fed, the next interest rate decreases might be pushed into next year. So I'm thinking I should sell this right now instead of letting it flounder and like go down a little bit at a time. I was wondering what you thought.
Yeah, I think I agree with you there. You know, I think we expect, or rather it was expected to get 200 basis points of cuts going into next year. Well, it turns out the economy is not as in as weak a spot as maybe we thought for that short-term monthly period. Now, I did a show a couple weeks ago about how maybe the best thing for the Fed to do is move into a period where they may not be as data dependent. And I don't mean not looking at data, but I mean not really waving like a bag in the wind every time new data appears. Because what is the byproduct of that? Well, you have these large shifts within the bond market. But I do agree with you. I do think that maybe now is the time to start thinking about trimming down on this. As you mentioned, you were up about what, 22%, 25%, you said. Now you're down up about 11%. I think given the dynamics of the bond market and how it's going to react to maybe even slower cuts than we expected, now would be a good time to start trimming down on this. Yes.
Great. Thank you very much for your help. I appreciate it.
Awesome. Thanks for the call, and call back anytime.
Hi, Luke. Yeah, I do have it in my portfolio, maybe less than 1%. I picked up maybe at the wrong time around COVID. So after 2 years, it's just gone up. So I'm more or less at the no profit, no loss stage. Do you think should I hold more or just take my investment out? Or should I buy even if you think otherwise? Thank you so much for your time.
Yeah, of course. Well, Carnival Cruises, as you imagine, had a pretty terrible pandemic. Why? People didn't want to be on cruises. People weren't able to go on vacations. And when you're worried about a global disease spreading, right, probably the last place you want to be is concentrated on a tiny ship with other people. Coming out of the pandemic, they did pretty well. And they continued to report record earnings. I mean, look at this. Revenue from about $1.9 billion in the pandemic. Even going before that, look at right before the pandemic, 2020 or 2019, $20 billion, all the way to $24 billion this year. That growth coming out of the pandemic was pretty fantastic. But one issue that has plagued this company and continues to plague this company is its debt levels. Right? It's a $27 billion market cap company. It's got $30 billion in debt. They've been paying it down a little bit. In 2021, they had $34 billion and then $35 in 2022, $31 the end of last year, and then $30 this year. But it's a pretty leveraged company that even though their cash flow is improving, even though their profitability is improving, they lost money in 2023. They're projected to make money this year, $1.32, $1.72. I think unless you are very risk tolerant, that given that you are back to at least break even in this case, there's just a lot of risk here, right? There's a reason why the valuation is dirt cheap right now. They're trading about 3 times price to book. They're trading about 12 times forward-looking earnings. By the way, their 5-year average is around 30 times. A lot of that's colored by the pandemic, but still, 5-year average is around 30 times. So for me, I think that the fundamentals of the industry in terms of people having more money to spend than a lot of people thought they would. Potential soft landing. The labor market's still strong. Wages still looking pretty solid is good. But with this company specifically, it's just a lot of debt on its balance sheet. And that's what worries me. So honestly, if it was me, I think there are better opportunities out there. Even though they have reported some pretty stellar earnings, I still think there's a lot of things that they have from a company specific perspective that they have to get past. So that's my advice on that one. Let's dip on over to the InvestTalk YouTube question bank and answer a question on ticker TTEK. It says, do you like TTEK to buy and hold? So TTEK is Tetra Inc. And it's a consulting and engineering company that addresses challenges in water, the environment, sustainable infrastructure. They should be benefiting from some secular tailwinds, and that is massive federal investment in renewable projects, right? This company is focusing on consulting and engineering services for water, environmental infrastructure, and renewable energy. So let's see how that has played out. Well, growth has been pretty solid, up from about $3.2 billion in 2021, projected to be $4.312 billion this year. And it looks like they have a pretty heavy backlog of new projects that could be some high margin projects. What has that done for their margins as of late? Well, over 5 years, they've gone from 4.5% net margin, projected to be 7.6% this year. Their cash flow looks to be improving. Their profitability is improving as well. They have very little debt, about $1 billion worth of debt on an $11 billion market cap company, and they pay a modest yet still solid dividend of about 50 basis points, 0.5%. In terms of their dividend per share, it's grown pretty well from about 9 cents per share to 22 cents per share. All the while they've bought back shares a little bit. About 275 million is where they started 5 years ago. About 270 million is where they are today. So everything to me looks good. Their chart looks pretty solid up and to the right. But because I am seeing that over the past 52 weeks, they are up about 60%, that leads me to the next question, which is how does their relative valuation look? Trading at 7 times price to book, well over their 5-year average, trading at about 32 times forward-looking earnings over their 5-year average as well. Price to sales about 2.6 times, still kind of modest, but over their averages. Price to cash flow, 35 times, 25 is their 5-year average. I think this is a story of what we see oftentimes, which is a company that has done particularly well because there are those secular tailwinds, and they do have a lot going for them. But at the same time, Looks to be a little bit overvalued to me, which is to be expected when you're up about 44% year to date. So I would keep this on my watch list. Fundamentally, it looks very solid. Technically, it looks solid. It's headed in the right direction. Growth looks good. Certainly, there could be some legislative risk depending on the outcome of the presidential election. Something to note there. But for now, I would keep this on my watch list. Thanks for the call. That was a YouTube comment. Thanks for watching. Let's go to Bill in California, because here comes another live call. Question about NEM. Do you own it or are you looking to buy it?
Yeah, hi, Justin. No, I started buying it mid last year and all the way into probably February or something when it was at its low this year. And I'd called and I think asked Justin when he was on his evaluation, maybe like, 2 months ago or something. But so apparently you guys hold it too in your managed accounts. And he was real positive on it with the long-term price of gold going up, this year. And I see it the same way, like the estimates on it, some are that, quite higher, like into the 70s even. And a lot of people have been, raising their estimates on the price. But now they came in with their, like the company's estimates today, and after hours, I see it's down like $3 or $4, which, is something to pay attention to. I'm not particularly worried because people overreact to stuff all the time. But what I want to ask you was, on those kind of estimates, those are the company's, estimates for their own stock price versus analysts' estimate. They missed their earnings estimate. That's what they say. I'm a little less sophisticated on that. That means they didn't come up to their own, what they were telling people. So how much value can you put in that? Unless it's something incredible amount. It's like they just said they were going to make more money and they didn't make that much money. Well, big deal if their earnings are still increasing in the longer short period, like in several quarters, and the price of their commodity is going up significantly. How much weight would you put into that? And have you guys had time to consider whether you're going to sell any of your position or not?
Yeah, well, certainly we do like gold, and Newmont is one of the names we hold for our clients. I think that the core message here is essentially when earnings have been digested, right? When you get that beat or, didn't hit what earnings are, though, they do provide guidance of what they expect revenue growth to look like, right? But there is still, after that happens, a lot of analysts that digest this and say, well, maybe we don't agree. Well, we think you're going to make more, you're going to make less. And you're right, they're down because they didn't quite hit estimates that I believe was probably their analyst estimates. But what I think the market cares more about, because this is revenue that's already in the bank, is what does it look like going forward? So I think when any time that earnings happen, focus less on the beat or the not beat and more of what the forward guidance says, right? Because at its core, what is the price of a stock? Well, it's supposed to be, if it's efficient, it's supposed to be generally future cash flows discounted to today. And so what I want to emphasize again, and certainly we think that gold is still a good investment to have, and we certainly think that this is still a solid company, is that focus less on what has happened in the past and more on what they say is going to happen in the future. That make sense?
Yeah, that does. Thank you.
Awesome. Have a wonderful day.
Look at their. Thank you so much.
Yeah.
Explore additional content and tools by heading over to InvestTalk.com.
Let's go out and grab another question. You know the number, 888-99-CHART.
This is TJ. I'm calling from the Desert Castle in Palm Desert. I meet every week with my colleague, and we discuss investments. And my colleague's really pushing me on Bitcoin to diversify. He says it's a piece of real estate you have to own. What is your perspective on Bitcoin? And do I need to be in this asset? It seems speculative to me, but I just want to know from your thoughts if it's an important asset to be in, if you think I should be in it for the long term. Thank you very much.
So is Bitcoin speculative? Yes. Justin says it all the time. It's the ultimate long duration asset. I think the point that I like to make is that you can separate Bitcoin from blockchain technology, right? Bitcoin is not something unique. You can take the code that underlies what Bitcoin is, its scarcity, its award mechanism for processing transactions on the blockchain, and recreate it. The only thing that makes it unique is that people give it preferential treatment as the de facto version of itself. And so within its speculative nature, sure, it has had crazy returns over the past 10 years. Does that mean that over the next 10 it'll have crazy returns? No. We know that past performance is not indicative of future results. Do I think it's going to replace the dollar? No, I don't think it's going to replace the dollar. Why? The US dollar is backed by the ability of the US government to tax and enforce its laws, right? That's what gives it value. But are you harmed by having a small allocation to Bitcoin? Probably not, right? It's a different asset class. It has similar correlations to some things, but still differing correlations. It does offer some diversity, but I just don't think it's for everybody, right? I think there is a lot of risk. You have to be a risk-tolerant person to put a substantial amount of money in Bitcoin. But if you want to have a 2-3% allocation to Bitcoin, I think that's completely fine. I don't think that's crazy. But you are right. It is an incredibly speculative asset that for the foreseeable future has no use case beyond what that speculation is. Thanks for the call. Now, we already mentioned one story about the housing market, so let's talk about another. And that is that sales of existing homes in the US are on track for the worst year since 1995. High home prices and elevated mortgage rates are discouraging potential buyers. And data from the National Association of Realtors confirms that home sales throughout the first 9 months of the year are lagging behind the same period in 2023. Now, in September, existing home sales fell by 1% compared to the previous month, bringing the seasonally adjusted annual rate to 3.84 million, marking the lowest monthly rate since October of 2010. This drop surpassed economists' predictions of a 50 basis point decline. On a year-over-year basis, sales fell by 3.5%. And because of this, hopes that 2024 would bring relief to the market were dampened by persistently high mortgage rates. But a broader issue is something that we have talked about from time to time, and that is tighter inventories. Many current homeowners secured low-interest loans during the pandemic era and are reluctant to sell those golden handcuffs, knowing they'd face much higher rates on new mortgages. As a result of not building nearly enough homes, housing supply remains limited, and that's what's keeping home prices elevated. The national median price for an existing home in September reached $404,500, a 3% increase from the previous year, the highest median price ever recorded for that month. Uncertainty around economic conditions is also affecting the market. Mortgage rates tend to follow the 10-year Treasury yield, which has hovered around 4%. But volatility in the bond market has driven a wider than normal spread between mortgage rates and Treasury yields, and so that's pushed up borrowing costs as well. Meanwhile, climbing home insurance rates and election year uncertainty are adding to buyers' hesitation. When there is that much uncertainty, do you want to make a large purchase decision? Homeowners who do jump into the market, though, they are finding some advantages. With fewer buyers, properties are staying on the market longer. On average, they stay on the market for 28 days, compared to 21 days just a year ago. What that does is it gives buyers more negotiating power. While more homes are available compared to last year, the market is far from balanced. Inventory levels remain below historical norms, with a 4.3 month supply available at the end of September, just at the threshold of what's considered healthy for both buyers and sellers. Real estate professionals expect that buying activity will likely remain slow through the holiday season, but some are optimistic that sideline buyers will want to return in 2025 when you have a little bit more political certainty. Whether market conditions will improve, though, whether it'll be enough to reignite sales remains to be seen, especially with mortgage rates unlikely to decline substantially in the near term. This is InvestTalk. Let's pivot back to our 24/7 voice bank and play another caller question now.
Hi, Justin or Luke. I have a small position in Nintendo, ticker symbol NTDOY. I plan to hold this position for the next 15 to 20 years. I like this investment because it is family-friendly business that is expanding their business into movies and theme parks. My question is, do you think this is a good long-term investment in comparison to the opportunity cost of investing in the S&P 500? Thank you for taking my call.
So let's take a look at Nintendo. Nintendo is a entertainment company made famous by honestly some of the best IP in gaming. I've said this for quite some time. Nintendo has the benefit of they essentially just take a handful of games and continue to make sequels to them, right? They're not really innovating away from what has been their core business for quite some time, except in that, like the caller mentioned, they are starting to look into movies. There was a Super Mario movie at one point. They're starting to look into pushing into theme parks, and this could offer a lot of growth for them. Now, on a 5-year basis, growth is a little bit less certain. Looks like sales have fallen. Back in 2022, their revenue was about $15 billion. Now it's down to $9.2 billion. Profitability has fallen as well, again, from a peak out in 2021. And valuations are honestly fine, but still higher than they have been. Price to sales, 6.3 times versus 4.3 times. Price to book, about 3.8. That's about it. It's 5-year average. And so the question becomes, as it was posed, how does it compare to the opportunity cost of investing in the S&P 500? Well, these are entirely different things, right? I don't think you should classify an individual investment in a company relative to an investment in an index. Why? You're trying to do two separate things. One is you're trying to essentially track, right, how the U.S. market moves. The other, you're thinking of investing in a company that you see that you believe has outsized potential for gains. And so where I am with this, honestly, is that although I do think they have phenomenal IP, although I do like their growth prospects, and honestly, they're trading at relatively cheap price, I think that the trend in their profitability and the trend in their cash flow and the trend in growth is something that leaves a little bit to be desired. So although their balance sheet looks great, they have pretty much no debt on a $61 billion market cap company. I would want to see how their plans for growth beyond their traditional video game business starts to pan out before I think about making an investment in Nintendo. Thanks for the call. Here's another question from our InvestTalk YouTube channel. This one on a stock that has 3 letters in their ticker, 3M, MMM. The question is, could I get your thoughts on 3M, ticker MMM? I bought it a year ago as a trade, and it has done well for me. I'm thinking of selling at least part of my position. It is about 5% of my portfolio. Okie doke. Just pulling something up on the left screen. So 3M is a manufacturing company. They have a whole bunch of products, Scotch Guard, a bunch of tapes, bunch of hardware products, bunch of home care products. And they have done really well over the past year, up 78% over the past 52 weeks. Now, one of the reasons that is because while they have had some reduction in the interest income and pension costs associated with the business that has shored up some of their balance sheet. And one thing that I think I do not like, however, is in terms of their revenue growth, which has pretty stagnated. Right, their relative strength relative to the S&P 500, though they have done particularly well this year, does not look great going back to 2019. Underperformed by their industry by 32% that year, then 5.5% the next year, then 2.6% that year, 18% the year after that. This is the first year that they are doing particularly well. Interestingly, or rather important to note also, that their most recent earnings report flagged that they have issues in terms of their previous forward-looking guidance on EPS and efficiency of their production. On a relative valuation basis, they're trading above their 5-year ranges. But again, they've had quite the run-up this year. I think overall, the big issue that I have with 3M is the revenue growth. Now, they've, like I said, shored up their balance sheet. They've made a lot of improvements, but their cash flow is still falling from a peak out in 2021. The relative strength, though improving, is still not in a great position, and their valuation doesn't make it look all that cheap. And so for me, 5.5%, it's a decent amount of your portfolio, but I think given the run up over the past year, given some warning signs, flags, in terms of the forward-looking guidance on production and their earnings per share, I would start to look to trim down on that and take some of those gains. Thanks for the comment. Now let's see if we can squeeze in at least the start to one more question now.
Hey, can I have your opinion on owning physical gold and silver instead of gold and silver stocks or ETFs? Thank you so much.
Yeah, so owning physical gold versus stocks and ETFs, well, I think there's a lot of things to consider here. But for me, the reason why I would advise holding ETFs is that you generally don't have purpose for the physical delivery or for holding physical gold, right? You're not a reserve. You're not a central bank. You don't need to hold the gold in your hands. And let's say you have $500,000 of gold and $500,000 of a gold ETF. What if you want to move the $500,000 of physical gold? Do you think you will get spot price of gold to move it immediately? I don't think so. I think if you want to hold these commodities, the reason why you hold it in these ETFs is because, one, you don't have to store it. Storage cost is inherently baked into the ETF. The other part is that when you need to get rid of it, it's highly liquid. Far more liquid than finding a guy to buy your stack of gold that you're holding in your basement. So I would generally advise for most people, if you want exposure to those commodities, do it in an ETF. Join our community of savvy investors. Subscribe to the KPP Premium newsletter for expert analysis and stock ideas. I think that last question was probably a good segue into my next topic. Gold is experiencing a powerful resurgence with its price climbing 38% in the past year to a record high of $2,700 about per troy ounce. This new golden age is driven by inflation concerns, instability geopolitically, and the actions of central banks looking to diversify its reserves. Even some retailers are getting in. Costco and South Korean convenience stores are now selling gold bars, reflecting heightened consumer enthusiasm. While it produces no income, the metal is prized during times of uncertainty. Evidence of that? Well, family offices that manage over $5.5 trillion in assets are increasingly turning to gold to protect against currency depreciation and market volatility. Countries are also doing the same. Notably, China and India, which account for half of the world's physical gold purchases, are seeing increased demand due to domestic challenges. In China, a real estate slump has driven capital towards gold, with purchases of bars and coins rising 44% over the past year. Central banks are also at the heart of this gold rush, reversing a long-standing trend of reducing their gold holdings. Russia's invasion of Ukraine and subsequent financial sanctions revealed vulnerabilities in relying solely on Western assets, but also the Western system. As a result, central banks in China, Turkey, India have added hundreds of tons of gold to their reserves since 2022. Now, the surge in central bank purchases has disrupted gold's usual relationship with interest rates. Historically, gold struggles when real yields on government bonds rise as investors prefer assets that generate income. However, gold prices have climbed even as U.S. Treasury yields have increased, reflecting a shift in market dynamics where security outweighs returns. Central banks now see gold as essential protection, with 70% identifying it as a hedge against inflation and 56% viewing it as a safeguard against the weaponization of reserves. Beyond central banks, ultra-wealthy individuals, institutional investors are also exploring larger asset exposures to gold. Demand for gold ETFs often rises following rate cuts, and with expectations of falling interest rates, institutional interest could grow as geopolitical tensions persist and inflationary pressures remain on the horizon. The demand for gold is unlikely to wane. And so with investors seeking refuge from market volatility and governments facing new financial challenges, gold seems poised to remain a central player in the global financial system. Looks like we got plenty of time, so let's answer one more question now.
I was wondering your opinion about Leggett and Platt, symbol LEG. Wanted to see what your thoughts were on the company and if you thought there was a good entry point. Thank you. Bye.
So Leggett and Platt is a global manufacturer that designs, manufactures products for furniture, automotive, bedding. Looks like their bedding products makes up about 42% of the revenue. Furniture is about 31%. Specialized products about 27%. Now, in terms of revenue growth, not too great over the 5-year time horizon, about 2.1% on an annualized basis, and certainly down from the revenue in 2021, though to be expected. People were making a lot of home purchases in that time. Let me pull up their margins on a different screen. That's ticker LEG. And so in terms of their margins, well, they lost money last year. They're projected to lose money this year. Their margins have been falling from 7.2% net margin down to 2.8 last year. Projected to be negative 2.8 last year. Projected to be negative 1.3 this year. Their cash flow is falling. Profitability is falling. They're issuing shares. They have about 5% short interest out there. And so what I'm seeing here is a company that, frankly, looks like it is cheap, but it is cheap for a reason. Their forward-looking earnings, about 9.8 in terms of price to earnings. Price to book, trading about 2.5. Frankly, I think this still might be a little overvalued, given its negative growth trajectory and the fact that it is losing money. Its balance sheet, they have $2.2 billion in debt on a $1.6 billion market cap company. I don't say this often, but I am looking and I'm not seeing much to like. So on Leggett and Platt, I would have to pass. I'm Luke Guerrero, and this completes another InvestTalk program. We thank you for listening, and we encourage you to tell your friends and family members about our free podcast downloads. Get yours anytime at iTunes, Google Play, and Spotify, but please be sure to rate and review us on iTunes. Remember, if you're interested, we can help you better understand your portfolio dynamics and calculate your investor risk number. Just go to investtalk.com and click the portfolio review button for a free and confidential portfolio review. Independent thinking, shared success. This is InvestTalk. Good night.